In investment management, sometimes saying no is more important than saying yes. Let me give you an example. Late last year, we considered an investment in the Gulf, the Middle East, in infrastructure projects, power plants for the endless air conditioning that you needed to live and work in the Middle East, water treatment plants to desalinate the water. So real key projects. And we looked at this and it looked very interesting. We pursued the investment a little further in terms of due diligence and found that the contracts were written under UK law and enforceable in the UK courts of arbitration. But we had some concerns about whether you could really enforce a contract against the Saudi royal family, for example, and we decided not to proceed. 6 months later, fast forward, and this fund that was launched and raised $125 million has actually had to admit that it cannot make any investments because it's not comfortable with the legal setup of those contracts. Investors would have invested at $100 per share, and now no investments made, and they're going to be getting back $98, a capital loss for absolutely no investments made. So not a great outcome for investors there, and it just shows how important the due diligence work is at the outset. Moving on to something different, Narendra Modi has actually been elected in India now, as we suspected and as I talked about last time. It's going to be a difficult road for him, but very exciting. He's seen as the leader of great reform and that he should be the one to shake up the civil service, cut red tape and cut the bureaucracy that stops and is stifling India. But it's not an easy job. Structural reform is tough. Now, we have some exposure to Indian equities, but they're not all cheap. And we continue to get our exposure to Indian equities via broad emerging market exposure across the region.